If you are wondering what property, plant and equipment is in your firm's accounts, this video will explain what it is and how we value it, and how we then turn this asset into an expense over time, so that you will be able to better understand what property, plant and equipment can tell us about what is really going on in our firms. Property, plant and equipment is a non-current asset that almost all firms have. It is also often a key asset for a business in driving its performance and success. Property, plant and equipment comprises most of the physical, non-current assets of a firm. These are the longer-term assets of a business that you can see, touch, use and experience. Ryman Healthcare has over $1 billion of property, plant and equipment, which for Ryman's includes land, care facilities, completed and under development, and Ryman's head office. A key thing to realise is that we first record property, plant and equipment at cost. That's right, when we first acquire property, plant and equipment, we record it at cost. And cost includes all those costs required to make the asset suitable for the purpose for which it is intended, including purchase price, costs for it to be capable of operating, and an estimate of costs of restoring the site in future. Like all other assets, property, plant and equipment is acquired by a firm because it expects to receive future economic benefits from these assets. And with non-current assets such as property, plant and equipment, these future economic benefits are expected to be received over a number of years. With the usual exception of land, all items of property, plant and equipment are not expected to last forever and to eventually wear out and cease to provide economic benefits to our firm. This using up of the expected future economic benefits of property, plant and equipment each year can be part of the puzzle of determining a firm's annual profit. Depreciation is our estimate of how much of the future economic benefits which we expect to receive from an item of property, plant and equipment that have been used up during the period to help generate the revenue for that period. And it is an estimate. There are no transactions, no cash changing hands, nothing. It is simply our estimate of the using up of future economic benefits of an item of property, plant and equipment during a period. Many people have misconceptions about what depreciation is. Many think depreciation represents our estimate of the decline in market value of property, plant and equipment. This is not the case. A key thing to remember is that depreciation is the process of turning part of our firm's assets, an item of property, plant and equipment, into an expense each year. Depreciation can be an important expense in many firms. Although depreciation can be a much smaller expense for some businesses compared to employee costs and costs of goods sold, it is an important expense to carefully understand because depreciation is based on judgments and estimates, and not on transactions with other parties. For further information on how we account for property, plant and equipment, go back to Chapter 5, Sections 5.2 and 5.3 in the study guide, and also review the Property, Plant and Equipment weekly questions. Also answer, write and rate questions on property, plant and equipment in Peerwise.